And a warm welcome to Invest Africa. I'm Nozi Pombanjwa. Now, on tonight's show, we're looking at investing in fragile and conflict-affected markets. Now, earlier this week, I spoke to Michelle Butzung. Michelle is the manager for fragile and conflict-affected states in Africa, and this at the International Finance Corporation. And the key conversation that we had really rallied around the importance of institutions like the IFC from the World Bank Group to be first movers in such markets so as to build more confidence for private sector investors to participate. Michelle, thank you so much for your time. Let's start off with the definitional issues. What is a fragile and conflict-affected state?
So a fragile and conflict situation, as we call them, it's based on a definition that is produced on an annual basis by the World Bank Group. So every year, during the summer, the World Bank Group, in partnership with the African Development Bank, is producing what we call the annualized and harmonized list of fragile and conflict situations. This is based on a combination of two main criteria. On the one side, it's really a ranking that is based on indicators related to the country political and institutional evolution. On the one side, we call that CPIA. And on the other side, it's the presence on the ground or the previous presence in recent years of UN peacekeeping mission. As of today, in this fiscal year, in 2015, we have about 17 countries in Africa that are part of that list. I think it's a very convenient tool for us, but also I think there are some weaknesses in that list and things that we would probably should start addressing moving forward. On the one side, it doesn't necessarily capture the sub-national or sub-regional fragility and violence and conflict. So, for example, what is currently happening in northern Nigeria and spilling over in the neighboring countries is not necessarily taken into account by this calculation methodology. But also, when we have this broader regional dimension, is not necessarily taken into consideration. So that's from a very, how shall I say, almost administrative standpoint. But I think we would all probably agree that those countries share the same characteristics.
Michelle, we agree that the methodology might be flawed, but what about the trends? Are we seeing it, particularly in Africa, are we seeing a growth in the number of fragile and conflicted states, or are we seeing that number come down?
Over time, the list is quite stable, I would say. Some countries do graduate based on the calculation. So, for example, last summer, we had the Republic of Congo and Malawi who both graduated out of the list. Previously, we had also the Republic of Guinea-Conakry that graduated out of this fragility and conflict list. I would unfortunately expect that with the Ebola outbreak, Guinea may come back into the list this fiscal year. We'll also see the impact of the political changes in Burkina. So I think overall the list is unfortunately quite stable from year to year.
Michelle, given that and the analysis that you've given us, why would an investor look to invest in a fragile and conflict-affected state?
I think that's the key challenge. There are a couple of different perspectives. We spoke a lot, as you can imagine, with external global investors, and they are telling us the following. They are to some extent reluctant, or they are really considering carefully investing in FCS due to, first of all, the political risk. So the political risk is really the main bottleneck from their perspective. And this is relying on a combination of a regulatory framework that may be evolving, some civil unrest, also sometimes the sovereign guarantee not being honored, also expropriation risk and the terrorism and war concern. So I think political risk is really the major challenge and the main issue that global investors are facing. In addition to that, there's also usually a pretty low level of infrastructure. So getting things and goods and services in the country and out of the country or serving major cities are challenges. And then we have the political environment that may sometimes be a bit volatile. So from a global investor's perspective, those are significant challenges to overcome. But we at IFC, we are committed to FCS and we see a significant potential in those markets, and we have actually over time increased our level of investments in those markets in Africa. So just to give you a couple of figures, our global target for FCS, including Africa but also going beyond, is about $1 billion a year. And last year in Africa alone, we did 530 million from IFC's own account, and we helped also mobilizing around 300 million from our partners. And that's a significant growth from, let's say, 2 or 3 years back, when in average we are making about $300 million a year. So there are opportunities.
So there definitely are opportunities, but let's talk about the kind of confidence that the presence of the IFC in that particular market would bring to an external investor. How do you go about communicating that this is an investment market that is ripe for investors to sow their seeds, particularly given the political challenges on the ground? So in essence, the question is, how does CASA do its work to get investors in?
Several ways. I think if I look back a couple of years back and about our practice, I think one of the things that we were used to do and that we still do in some cases is once a government has made significant progress at improving the regulatory framework, we jointly organize an investors conference. So that's a model that we have been rolling out across several markets. We did that quite successfully, I must say, in Sierra Leone and Liberia a couple of years. We had also a big investors conference in South Sudan in December 2013, unfortunately just a couple of days before the civil war resumed. So bringing international investors and taking them to the country and exposing them to the changes that were made, particularly on the regulatory front, is one approach that has been practiced and that we will keep on doing as much as possible with our partner governments. On the other side, I think there's what we call the demonstration effect. So when IFC is really getting into a market, taking the risk of investing into a specific market, I think it sends out to the broader investment community a very strong signal that this country is open for business and that there are opportunities to consider. The other way we do it is actually, as often as possible, co-invest with other investors. So that's a way for us to highlight this demonstration effect, but also for them and for us to some extent to mitigate the risk. So if I could give you an example of an investment that we recently did in Malawi, Malawi mango. So it's not a big investment. It's $15 million, but co-invested with GAFSP, a global agribusiness and food security program, and with our Dutch partners from FMO. Altogether, we put $15 million on the table to help really developing a very promising agribusiness firm specializing in mango. So that's a good example. And we have done that similarly at a much higher level in helping Côte d'Ivoire to increase his access to electricity by investing in some key power generating plants in the country with a large range of co-investors.
Michelle, let's talk about the entire spectrum of World Bank Group initiatives that would be needed to come together for an investor to come in. At the top of my mind, I start thinking about partial risk guarantee loans that might have to come in, maybe even MEGA having to participate for a big investor to get involved in a conflict-affected state. Talk to us a little bit about the kind of turnkey or comprehensive interventions that a deal like what you would see in Côte d'Ivoire and in the power sector there would require.
You're absolutely right that mitigating the risk is one of the key elements. I think FCS is not business as usual. So I think we have to go significantly beyond what we would be doing in other markets. What we have learned over time in Africa and beyond is that developing a pipeline of investment and building a portfolio in FCS countries really relies from us at least two main things. On the one side is much more flexibility. So we have to be ready to accept that the deal may take longer to be structured and to be committed. But also it requires a lot of capacity building for the local government on the one side, but also to the firms in which we are investing. So it's this combination of flexibility and capacity building or technical assistance, as we call it sometimes, is absolutely key to make a difference in those markets. But you were asking about how do we mitigate risk? So I think previously I highlighted the fact that we co-invest with other partners. So that's definitely one way for them and for us to mitigate the risk. The other point, as you highlighted, is that we increasingly rely on our colleagues and friends from MIGA who can provide insurance against those political risks that you were mentioning. And I think the third element that I would highlight is the work that we do in many African FCS on helping to improve the regulatory framework. So we have teams on the ground, we have experts on the ground who are working closely with the government to address some of the key challenges and key issues that investors may be facing. So improving this overall investment climate and enabling it is a key additional activity that is being used to mitigate the risk. So the last point I would like to add is the fact that we are increasingly relying on tools that we don't necessarily use as much in other markets. But I think they really prove all their value in fragile and conflict situations. And here I'm mostly talking about blended finance. So in partnership with development partners, we have the ability to actually access pools of funding that allow us to extend part of the loan at a sub-commercial rate. So I think this blended finance, which is totally justified in fragile and conflict situations, is a tool that we are increasingly relying upon and mobilizing for most of our investments. And we expect to actually significantly increase this envelope moving forward.
Absolutely, that's a very interesting insight. But let me just get a quick answer from you on whether, as an investor, as the IFC who's invested in conflict and fragile states in Africa, whether you've realized your returns, because that would be perhaps the biggest demonstrable effect that you could have for external investors.
We need to adopt a long-term perspective, to be frank. I think we are assessing each and every deal with a lot of caution, but also with an increased risk appetite. For the overall performance of the portfolio, I think one needs to adopt a long-term perspective. That's absolutely key. So those countries are fragile today. We expect that we are in a good position to help building a vibrant private sector. But for the overall portfolio profitability, the long-term perspective is really needed. So we need investors who share this long-term perspective and are confident in the prospects that some of those markets are offering.
It's time for us to take a quick break, but when we come back, we begin to talk to some of the private sector players in the market and get their experiences of what it's like to do business in a fragile and conflict-affected state. Welcome back to Invest Africa. Tonight we're looking at investing in fragile and conflict-affected markets. Now remember that you can be a part of these conversations. That's by tweeting us at CNBC Africa and of course using the hashtag InvestAfrica and of course following me at The Real Nozi. Now recently I attended an IFC conference in Washington where I got some first-hand accounts from CEOs about doing business in fragile and conflict-affected states. Let's maybe also just firstly talk a little bit about your company and just describe to us the products and the services that you're bringing to the market.
Right now I'm more focusing in interior construction, which is in design and for home and office. It is an open market in Burundi because everything before was imported from China. So everything is making today locally with Feral, which is like bringing a new perspective of quality and design for Burundi or elsewhere.
Is this been supported and enabled by a change in government policies that are promoting and prioritizing localization over imports from other markets like China?
Not yet. It's still an improvement, but we are not quite there. We still have more produce from China than locally made. But I think it is open for in the future because we still have a challenge when it comes to vocation training. So the production may not be as much as sufficient that we are looking for right now.
Do you believe in the narrative that we've been hearing today that the private sector has a very big role to play in assisting the country to move forward from its conflict-affected, let me call them issues? Do you as a private sector player see yourself as responsible for moving the country forward?
Absolutely. I think my role right now is to motivate youth to be part of creating jobs. So yes, I do believe that it is the way to go to creating job when in the conflict country like myself, like in Burundi. Yes.
And of course you have some support from the IFC. Talk to us about what that support entails and what it's enabled you to do through your company.
IFC actually have a program with Business Age, which is the program I would say, a platform for entrepreneurs to discuss about their challenges, the idea, the resources. But the mostly for me to have the courses, it was an open book to talk about myself with other entrepreneurs. And then for the first time, I felt less alone and understood. It was amazing because you feel like it is the courses what we had that time was like how to make a quick decision as an entrepreneur. You think like it's easy, but for me it gave me more confidence with my everyday decision. So yes, it make an impact in my life and then in my company also.
Talk to us a little bit about the focus of the company and how you intend growing that in Sierra Leone.
Okay. Now, moringa is a multivitamin, multi-mineral plant full of 46 antioxidants. So it is basically used to prevent malnutrition, to treat malnutrition, but also for general wellness. We spend a lot of money buying international products, multivitamins, when this is grown in our own backyard. So my first focus is to provide jobs. Even though I have my own farm, I buy leaves from outgrowers, and I believe if we can put monies in people's pockets and food on their tables, especially the women can look after their families. I can develop a business, I can employ people, because all over the world now, no government can afford to fully employ its people. So it depends on the private sector. And this is where I see myself and growing my business so that we provide more employment, more training, more stability in the country.
And how does the support from the IFC help you to build the capacity to create even more jobs and to be part of the solution of moving from fragility to stability?
It's before IFC, I started the business in my kitchen, just myself, then out to my balcony. And then IFC were part of a program to find business entrepreneurs in Sierra Leone. Business Bomba it was called, and I was the first winner. And with that, I applied to IFC and I got a grant. So I was able to build a purpose-built factory. I was able to go buy equipment, employ more staff. I was able to develop my 30-acre farm. So without IFC, I couldn't have done any of this. So, and apart from that, it isn't just the financial support. I mean, they give technical support as well through the West Africa Venture Fund in Sierra Leone. So I have people who basically look after me. Yeah. To make sure that the business, because the thing is not just starting the business, it's making sure the business is sustainable.
Right. Let's talk about your business targets as a final question. You're receiving this support, which is also technical support. What are the targets that you've set yourself for the next financial year?
Right. Number one, I want to increase my product range. Right now, I do moringa teas, moringa powder. In the next 3 to 4 months, we're hoping to go on to producing moringa capsules. Another target, say towards the end of the year to the start of next year, is to produce moringa oil, which is used in the cosmetic industry. So right now, I'm at the stage where we've more or less saturated the whole market. So I am looking for external markets, access to markets, so that I can grow my business. and employ more people.
Now, as much as we know that foreign direct investment is important for fragile and conflict-affected states, aid still has a role to play. So I spoke to Kim Kusman, and he's from Norway, and I began by asking him why a country like Norway would be interested in helping fragile and conflict-affected states.
Well, I think conflict-affected states have for a long time been receiving less development assistance than many other countries. And when a country is in conflict, that also affects how investors look at a country. So that means that you kind of more or less get a double whammy in delays, and you get a hindrance in rebuilding the economy. So really, from a development perspective, supporting private sector development in fragile states is a way of assisting a faster return to normality, to create those jobs that are needed to get back and to create hope for the everyday person, that here is really something positively happening, and that the economy will be growing, and we can confidently reinvest our own money also into the economy in that particular state.
So how are you practically assisting the private sector to go into a market that they would otherwise consider unattractive?
Well, they are, of course, traditionally working with the private sector in these states is difficult. We do all the normal things that we do when you consider an investment. All the investment analyses are the same that we apply in a fragile situation as you would elsewhere also. But then on top of that, of course, you have to consider that there are special circumstances. There may be political affiliation, there might be ethnicity to take into consideration. There may also be different skill sets that are not there, which would be in other situations. So what we do is we try to apply what we call a conflict lens. So really try to see if we can find out what is that is needed in addition to what we would normally do to really make that business succeed. So that's how we try to really adapt and be flexible and provide things in a different manner than we normally do, and try to go, if you will, the extra mile, and also be willing to change things midway that we would maybe not normally be so keenly doing.
And of course, the transition from fragility to stability is a long-term process. It takes many, many years. What are some of the key lessons or insights you've picked up from these processes that you could share to other donors who are looking to get into the space?
Well, there are a number of lessons. I mean, I think the thing is that we have learned that this is really worthwhile. That's number one. I think the most important lesson, and the reason being that we have to then consider that these businesses that are being established, they would frequently not really be established. That means that you are creating new jobs that would otherwise not have been there. You are building the economy faster than would maybe organically have been happening. But you also need to be willing to really be more flexible and adaptable, and be careful in your analysis before going in. You need to look into that particular investor and say, what is it that is really needed here, and maybe there are things that are needed that would not normally be needed in, say, a regular environment.
And of course, one would suspect that you would need buy-in from the domestic electorate to fully support these states. Is there, by any chance, a development of donor fatigue when it comes to pouring donor funds into Africa and really into fragile states where the electorate has not seen the benefits in the short time frame?
Well, of course, I cannot speak for everybody here, but I can speak for myself, and I think that when it comes to that particular point, no, actually, I think I'd like to keep it.
Not that one.
Yeah,
Okay,
yeah.
so let's take as a final question. Are there any specific success stories that you would like to share from the interventions and donor support that have come out of Norway?
I think what we would like to share is through the CASA program that we have been able to achieve a number of new enterprises in places and under circumstances that we have not otherwise been able to do. Also, we have seen that enterprises, they are much more resilient than we would have expected them to be, and entrepreneurs are much more resilient also and willing to learn and change, and given the opportunity we can actually do a lot in this environment. So I think what we have learned is that we definitely have a role to play here to move things forward under these circumstances. I think that's one of the biggest lessons that we have learned.
Well, that's all we have time for tonight. Please remember that you can certainly send us your comments. The details are on your screen. We want to know which investment sector in Africa is on your radar. For myself and the Invest Africa team, it's goodbye for now.